Most traders don't lose because they're impulsive. They lose because they're blind. Blind to the larger picture. Blind to the storm that's been building quietly on the higher time frame. Blind to the iceberg underneath the calm surface they just entered. You see, they've been told that trading is about setups, patterns, green candles. If this line crosses that line, boom, entry. They spend hours memorizing candlesticks, perfecting indicators, drawing levels. And then, the perfect trade fails. Not once, not twice, over and over again. Here's the truth nobody talks about. Your strategy isn't broken. Your logic isn't wrong. You're simply looking through the wrong lens, like a pilot flying through a thunderstorm, while staring only at the fuel gauge. You need a radar system, not just a chart. Let me show you something. A 5-minute chart is like looking through a straw. It shows you the tiny dance of price. But what if that tiny bounce you're about to buy is just a dead cat in the middle of a crashing daily downtrend? What if that beautiful breakout is happening right under a weekly resistance that's already rejected price 3 times? What if you're not wrong, you're just unaware? Today, we're going to change the way you see markets forever. I'll hand you a 3-layer radar system that separates illusion from structure, noise from signal. No more guessing, no more surprises. You'll see what the market's really doing, not what it's pretending to show you. Because trading isn't just technical, it's psychological. And the most dangerous belief a trader can hold is, what I see right now is all there is. It's not. There's an entire world moving underneath your chart. And once you see it, you'll never trade the same again. Welcome to Trading Psychology Stick, where we don't just analyze charts, we decode the hidden psychology that moves markets. Quick disclaimer, this is not financial advice, just one trader sharing hard-won insights with another. Your money, your decisions, your responsibility. Ready? Let's begin. Section 1. The mirage of the perfect trade. You stare at the chart. The setup is beautiful. A clean breakout, volume increasing, momentum aligned. You press the button, long, and then it turns. Almost instantly. It drops like you were the liquidity target all along. You sit there, heart pounding, wondering, what just happened? This is the mirage of the perfect trade. It looks flawless until it isn't. And the reason isn't your strategy. It's the context you never saw. Imagine this. You're driving on a sunny road, no clouds in sight. But 10 miles ahead, a thunderstorm is ripping trees from the ground. You don't see it until it's too late. That's what most traders do. They trade what's right in front of them. The 5-minute chart, the 15-minute breakout, unaware that the higher time frame is screaming a completely different story. The truth is, no setup exists in a vacuum. Every green candle, every pattern, every breakout is nested inside a larger narrative. And unless you know the story above your story, you're just reading a random sentence from a novel and thinking you know the plot. Let me tell you about Ray, a trader I met in 2021. Sharp guy, obsessive with entries. He traded the 3-minute chart like a surgeon, precision, discipline, everything by the book. Lost $47,000 in 6 months. You know why? Because Ray never looked up. Every time he got stopped out, it wasn't because his setup failed. It was because he was trading counter to the storm forming on the 1-hour and daily. Breakout longs during HTF distribution. Shorts during strong HTF uptrends. Perfect trades. In the wrong weather. This isn't about using more charts. It's about seeing with more depth. Because once you zoom out, truly zoom out, you start to realize something uncomfortable. The market didn't betray you. You just never saw what it was actually doing. And that realization, it stings. But it also frees you. You start asking better questions, not, is this a good setup? But good compared to what? You begin to see that your perfect entry on the 5-minute is just a flicker in a much larger wave. And if that wave is crashing against you, no candle pattern in the world can save you. Quick gut check. Think about your last losing streak. How many of those trades looked perfect on your time frame but were fighting a bigger trend? If you're nodding right now, comment context below. Let's see how many of us have been trading half blind. But recognizing the problem is just step 1. The real question becomes, how do I see the full picture before I commit? Here's where things get tactical. Section 2. The 3-layer radar. Picture this. You're flying a fighter jet through enemy territory. Your speed is unmatched, your reflexes razor sharp. But there's one problem. You only have a windshield, no radar, no tower communication, no satellite intel. You're flying fast, straight into the unknown. That's exactly how most traders operate. They think they're equipped because they have indicators, setups, and discipline. But without context, without a radar, they're just reacting to what they see. And by the time they realize what's really happening, it's already too late. Time to change that. Introducing the 3-layer radar, a simple but powerful mental model to help you trade with awareness, not just information. Here's how it works. Layer 1 is the high-altitude radar, your higher time frame, your macro weather. Think daily or 4-hour chart. This doesn't tell you when to trade, it tells you what kind of day it is. Are we trending up, drifting sideways, building pressure? This radar gives you direction, not entry. Layer 2 is the mid-range radar, your trading time frame, maybe 15 minutes. This is where you set up your mission. You map zones, recognize pullbacks, locate structure. It's like plotting your flight path inside the wider weather system. And finally, layer 3 is the low-level radar, your execution lens, the 3-minute, the 5-minute. This is where you find precision, entry triggers, rejection candles, micro-failure tests. This radar lets you strike with surgical timing. The key, these layers don't replace each other, they complete each other. Think of it like music. The higher time frame is the key the song is written in. The trading time frame is the melody. The lower time frame, that's the rhythm. Miss any of them, and you're out of tune with the market's song. Let me bring this home with a story. In late 2023, during the Bitcoin pullback from 45K, a trader named Eli caught the exact bottom of a 3-minute reversal. It was a textbook entry, divergence, failed breakdown, strong engulfing candle. But within 10 minutes, price collapsed another 800 points. Why? He didn't realize he was catching a falling knife in the middle of a violent HTF liquidation cascade. His 3-minute radar was clean. His 15-minute chart was sideways, but the 4-hour was bleeding aggressively. That 4-hour downtrend had already eaten through 3 support levels, and Eli was trying to fight it with a 3-minute candle. After that 12K loss, Eli rebuilt his approach. He drew 3 boxes on his screen: HTF trend, TTF structure, LTF trigger. He never took another trade without all 3 aligned. His win rate jumped from 42% to 71% in 90 days. So here's the uncomfortable question. Are you flying blind, reacting to signals without knowing the storm that's building overhead? Or are you layering your vision like a pro pilot scanning the sky before ever touching the throttle? Because once you activate all 3 layers of the radar, you don't chase setups anymore. You wait for alignment. And when it comes, you strike like lightning. Quick reality check. Most of you reading this trade only one time frame. Am I right? But here's the thing. Even with perfect radar, if you don't know how to adjust for altitude, your entire system can fail. Time to talk about scaling. Section 3. Altitude matters. You wouldn't use the same oxygen mask at sea level that you'd need at 35,000 feet, right? Because altitude changes pressure, changes breathing, changes the rules. And in trading, altitude is your time frame. And if you don't scale your tools to match it, what works in one layer will fail catastrophically in another. Here's where most traders get it wrong. They find a system that works on a 5-minute chart, say a 1.5 point stop and a 3-point target. Beautiful. But then they apply the same system to the hourly chart and wonder why their trade gets stopped out like a bug on a windshield. Or worse, they under-risk the trade and miss the entire move. This is the altitude mismatch, and it's deadly. Because as you move higher, from LTF to TTF to HTF, everything stretches, the candles get bigger, the noise becomes structure, and volatility expands. If you don't scale your stop loss, your target, your expectations, your risk management becomes delusional. Let's make it real. Imagine you're trading the 5-minute chart with a 1.5 point stop on the S&P. Now, you want to take the same pattern, maybe a breakout pullback, but on the hourly. You can't keep the same stop size. You'll get destroyed. You need to adjust by scale. The magic formula? The square root of the ratio between time frames. Say 60 minutes divided by 5 minutes equals 12. Square root of 12 equals roughly 3.46. Multiply your original stop, 1.5, by 3.46, and you get around 5.2. Now you're using a stop that actually respects the terrain of your time frame. Think of it like hiking. The higher you go, the more gear you need. You don't wear flip-flops to Everest. And you don't use 5-minute stops on hourly trades. This concept doesn't just apply to stops. It applies to position sizing, target expectations, even psychological tolerance. A pullback on the 5-minute might last 5 candles. On the daily, it could drag for 2 weeks. If you don't mentally prepare for that altitude shift, you'll bail out right before the trade resolves. Let me tell you about Sam, a trader who used to scalp the NASDAQ 1-minute chart. He was good, quick decisions, tiny stops, fast exits, made consistent $500 to $800 daily. But he wanted to go bigger, longer trades, more size. So he moved to the 1-hour chart, and everything broke. His stops were too tight. He exited too early. He couldn't hold through the natural breath of the market. Until he learned this, scaling isn't just numbers, it's psychology. He recalibrated his system using the square root scaling model, adjusted his mental expectations, and something clicked. He started treating the hourly chart like its own universe. His daily P&L went from 800 to 3,500, same edge, different altitude. So ask yourself, are you trading at the wrong altitude with the wrong tools? Are you bringing a paper map to a drone strike? Because once you respect the vertical dimension of trading, you stop fighting the chart and start flowing with it. Even with perfect scaling, most traders still fall for the biggest trap of all, beliefs they've been taught that sound smart, but sabotage them daily. Time to shatter some glass. Section 4. The 3 lies of time frame trading. Some of the worst advice in trading comes wrapped in confidence and repeated so often it becomes gospel. Only trade with the higher time frame trend. Higher time frame patterns are always stronger. Wait for all time frames to align before taking a trade. On the surface, they sound smart, safe, even logical. But what if I told you they're not just wrong, they're dangerous? Let's start with the first lie. Only trade with the higher time frame trend. Sounds reasonable, right? You don't want to fight the tide. But here's the catch. Some of the best trades happen at the exact moment the higher time frame is turning. If you're always trailing behind, waiting for confirmation across all layers, you'll miss every market turn. You'll buy tops, sell bottoms, and call it discipline. The second lie, higher time frame patterns are more important. Yes, HTF gives context, but markets don't always obey that hierarchy. Control shifts. Sometimes the 5-minute grabs the wheel and leads the entire structure. A micro failure on LTF can signal the exhaustion of an HTF trend. If you ignore the lower time frame's voice, you'll be deaf to the warning signs of collapse or opportunity. And the third lie, wait for all time frames to align. It sounds like precision, like sniper-level patience, but it's actually a recipe for paralysis. Because the truth is, alignment is temporary. It flickers. If you wait for everything to line up perfectly, you'll rarely pull the trigger. And when you do, it might already be too late. Let me show you how this plays out. Lena, a swing trader I coached, used to obsess over alignment. She'd check the 4H, 1H, 15M, 5 emitter, and if even one of them looked off, she'd skip the trade. Her journal, 87% of trades skipped. The 13% she took, late entries, low reward, maximum stress. One day, March 14th, 2024, she watched a 15-minute bull flag break while the daily was still in consolidation. She hesitated. It's not aligned, she told herself. That move ran 6R in 2 hours. NVDA, if you're wondering. 467 to 485 while she watched. That was her wake-up call. She stopped worshiping alignment and started studying transition points. The moments when one time frame was losing control and another was taking over. Her edge didn't come from being in sync with the crowd. It came from sensing the shift before the crowd did. The real problem isn't the time frames. It's our rigid rules around them. So, let's rewrite the script. Instead of only trade with the HTF trend, ask, is the HTF trend exhausted or just resting? Instead of HTF is always dominant, ask, who's actually in control right now? Instead of wait for all to align, ask, what's the opportunity if I act before the alignment? Because the market doesn't reward certainty, it rewards awareness. So, I challenge you, let go of the lies you've been told. Start listening to what the market is actually saying, not what you expect it to say. And you'll start to see opportunities where others hesitate. But now that we've stripped away those false beliefs, the real game begins. Because the question isn't just what time frame you follow, it's who is flying the plane when things move fast. Time to find out who's really in control. Markets are like airplanes, always in motion, but never with a single hand on the wheel. One moment, the captain is in control. The next, it's the co-pilot. Then suddenly, autopilot takes over, and you don't even notice. In trading, those pilots are your time frames. And the secret most traders miss? Control constantly shifts. You think the daily chart is the captain? Sometimes yes, but not always. In fact, the 1-minute chart can hijack the whole plane during news events. The 5-minute can lead a breakout while the 4-hour dozes in consolidation. And every so often, the weekly chart slams down the throttle, and every small candle just melts with it. If you don't know who's flying the market, you're just a passenger, and passengers don't survive turbulence. Let me take you back to early 2024. A major breakout was building in Ethereum. Daily chart, tight consolidation, 4-hour, coiling. But then, the 15-minute sparked a mini fake-out. Most traders jumped in, thinking they caught the launch. But on the 5-minute, something sinister was unfolding. Failed continuation, sharp rejection, and a massive liquidity flush. The pilot had changed without warning. Those who were watching saw the LTF take the wheel. They bailed out. Others, they stayed strapped in and rode the wreck down 140 points. So, how do you tell who's flying? You listen. The dominant time frame is the one setting the tone. It's not always the biggest, it's the one others are reacting to. If the 5-minute fails to break new highs 3 times while the 1-hour does nothing, who's in control? Not the hourly. If the daily shows a strong trend, but the 15-minute keeps rejecting key levels with volume, the lower time frame is rebelling. And when that rebellion succeeds, the trend changes. This is what elite traders see. Not just charts, but hierarchies shifting. Not just patterns, but power being passed like a baton between time frames. They don't trade what they wish was happening. They trade who's holding the controls now. And here's the beautiful twist. When you learn to recognize these shifts, you don't need to predict. You don't need to hope. You just follow control like a heat-seeking missile. Ask yourself, when was the last time you paused before a trade and asked, who's flying this? Was it the LTF whipping back and forth like turbulence? Was it the HTF humming forward like a silent freight train? Or were you flying blind, assuming control without confirmation? Because once you can see control passing, once you know who is flying, you no longer get caught in the chop. You ride the handoff. Quick exercise. Pull up your main trading pair right now. Check 3 time frames. Which one is making the others dance? That's your current pilot. If you can identify it in under 30 seconds, type pilot found in the comments. If not, you know what to practice. And speaking of practice, what if the perfect setup you're about to enter is actually a trap laid by the last pilot as they pass the wheel? That illusion has cost traders millions. It starts with the thrill. The pattern is flawless. Price consolidates. A breakout forms. Volume spikes. It all screams one word, entry, and you obey. But within minutes, the trade fails. A sharp rejection, a sweep of your stop. Confusion floods in. You did everything right. So why did it go so wrong? Because you didn't fall for a bad setup. You fell for a good setup at the wrong time. You fell for the illusion of strength. Here's the truth. Even the cleanest patterns can crumble when placed out of context. What looks strong on the surface might be built on sand. On a decaying structure, the higher time frame is about to crush. Let's revisit a real moment. November 2023. A trader named Alex spots a textbook bull flag on the 5-minute NASDAQ. Everything aligns, RSI reset, breakout candle, strong support just below. He enters with confidence, 10 contracts. Price moves 0.5R in his favor. Then, a slow bleed. It fades, stalls, and finally reverses with force. Loss, $3,200 in 7 minutes. What happened? On the surface, a strong setup. But above it, the 4-hour was printing lower highs. Daily volume was drying, down 40% from the weekly average. There was no real buyer conviction. Alex had stepped into what looked like momentum, but was actually just the market catching breath before another leg down. And this is the hidden danger. Setups lie. Context doesn't. You can find the same pattern, bull flag, double bottom, head and shoulders, across every time frame. But without knowing the environment, you're guessing. Because a setup is not a signal, it's an expression. And without structure to support it, it's nothing more than a decorative chart tattoo. Here's the mindset shift. A strong setup means nothing until you ask, What's the higher time frame doing right now? Is this a continuation of power or a desperate gasp against it? Is this pattern supported by structure or floating in space? Elite traders treat setups like detectives treat evidence, never in isolation. They build a case, and if the higher time frame doesn't support the narrative, they walk away, no matter how perfect it looks. Let me be blunt. That ascending triangle on your 5-minute, if the daily is in a downtrend, it's not a launch pad. It's a bear flag in disguise. That double bottom that just formed, if the weekly is at major resistance, it's not a reversal. It's a pause before the next leg down. Because the best entries aren't the ones that look good. They're the ones that align with invisible pressure, the tide you can't fake. So, how do you stop falling for the illusion? Simple. Before every trade, ask yourself, is this setup part of a bigger structure or a standalone hope? Because hope doesn't pay. Alignment does. And that brings us to the next layer, one that separates reactive traders from precision killers. The failure test. It's not about predicting what works, it's about catching what fails first, and using that failure as fuel. Ready to spot the trapdoor? Section 7, the trapdoor entry. Imagine walking across a stage, the lights are bright. The audience is silent. Every step feels steady. Then, snap. A section of the floor disappears beneath you. You fall through a hidden trapdoor you never saw coming. That's exactly how traders get caught. Not by bad trades, but by setup failures that were designed to look flawless. But what if I told you there's a way to spot the trapdoor before it opens? Not by avoiding the setup, but by recognizing the precise moment it fails to continue. That moment is called a failure test. It's one of the most potent signals in trading, not because it confirms strength, but because it reveals weakness. It doesn't predict the move. It reacts to what the market just rejected. Let me explain. A failure test occurs when price attempts to break a key level and fails. Maybe it pokes above resistance and gets slammed back. Maybe it dips below support and snaps back like a spring. That rejection tells you something critical. The market attempted one direction and decided against it. But here's where it gets powerful. Failure tests become especially meaningful when aligned with your radar. Say your HTF is trending bullish. Your TTF forms a clean bull flag. Then your LTF shows a sweep below the base, a sharp wick, and a close back inside the range. That's not noise. That's a trapdoor snapping on bears. And when the door closes, the rocket ignites. This is how smart money hunts. They push price beyond key zones to trigger stops, force weak hands out, and then reverse with size. Retail sees the breakdown. Professionals see the liquidity grab. Let's anchor this with a real example. In May 2024, gold was coiling near multi-month resistance at 2,425. On the 4-hour chart, it looked exhausted. But on the 15-minute, a sudden drop below minor support at 2,418 caught attention. A massive red candle that stopped out longs. Yet within minutes, price snapped back, closed above the breakdown, held, then exploded $30 higher in 2 hours. The traders who recognized the failure test entered at 2,420. Exit, 2,450. Clean 30-point ride. That wasn't random, it was a failure test. And those who saw it entered with pinpoint accuracy while everyone else panicked. But here's the key. Failure tests only work when you understand the layers around them. If you try to trade every fakeout you see, you'll get chopped. But when that trapdoor aligns with HTF trend, with consolidation, with clear pressure, it becomes a launch pad. So next time you see price failing a level, don't just dismiss it. Ask, is this failure just noise, or is it the rejection that confirms intent? Because the market rarely announces its next move, but it almost always whispers its rejection first. And when you learn to hear that whisper, you stop entering early and start entering with precision. But this precision only matters when the storm is quiet, when volatility compresses and fools get greedy. Because in those quiet moments, the market sets its most dangerous traps. And nowhere is this more true than in sideways markets. Section 8. Why chop isn't boring, it's a clue. Most traders hate sideways markets. They call it chop. They roll their eyes. They complain about fakeouts, indecision, lack of direction. But here's what they don't realize. Chop isn't the market taking a break. It's the market laying a trap. Because inside every range, every quiet consolidation, every boring moment, something's building. Pressure, liquidity, conflict. And when that pressure resolves, it doesn't tiptoe out. It erupts. The biggest moves don't come from chaos. They come from silence. Let me paint a picture. Imagine a room filled with gas. You don't hear anything. You don't smell it. But the air is thick, invisible, waiting. Then someone lights a match. One flick, and the entire room explodes. That's a range-bound market. What looks like nothing on the surface is often a war beneath. Bulls and bears accumulating. Institutions absorbing. And when one side wins, the move is violent. Here's how traders get destroyed in chop. They trade every fake breakout. They grow impatient. They try to force direction in a market that hasn't chosen sides yet. But here's how pro traders thrive in it. They observe the compression. They track where stops are likely to cluster. They identify who's getting trapped and wait for the break against them. Let me give you a real story. Summer 2023. The S&P 500 was locked in a 2-week range between 4,200 and 4,250. Twitter called it dead. Reddit called it rigged. But one trader, Marco, called it opportunity. He watched volume taper, down 65% from average. He mapped every false breakout. He tracked who got trapped. 7 failed breaks higher, 5 failed breaks lower. Then one morning, CPI dropped. Price swept the range lows at 4,195, a brutal fake breakdown. But Marco knew what was happening. A spring, a final liquidation. He entered long at 4,032 right as the market reversed, and caught the cleanest 3-day trend of the month. Exit, 4,315, over 100 points from a dead market. Because while others saw chop, he saw contraction, and contraction always precedes expansion. Here's the mindset shift. Sideways doesn't mean indecision. It means preparation. Ask yourself, are you panicking because the market's not moving? Or are you patiently studying where the explosion will begin? Because when you treat consolidation as a battleground, not a pause, you stop trading boredom and start trading intent. So next time you open your chart and sigh, it's just going sideways. Remember this. That's exactly when smart money is positioning, and exactly when retail is falling asleep. Guess who wins when the match is lit? Quick breather here. We've covered a lot of ground. The 3-layer radar, altitude scaling, control shifts, failure tests. If you're feeling the pieces clicking together, drop a clarity in the comments. Your brain is rewiring how it sees markets, and that's exactly what should be happening. But even when you're prepared for the breakout, there's still one crucial skill that separates chaos from control, timing your entry from the right radar. Here's how to strike like a sniper. Section 9. Sniper logic, entry from structure. There's a reason snipers don't shoot the second they see movement. They wait, they breathe, they line up the shot not just on the target but on the moment. That sliver of time when conditions align, wind, posture, distance, and the bullet becomes inevitable. Trading is no different. Most traders pull the trigger too early. They see the setup, feel the FOMO, and rush in. But pros, they wait for structure, for confirmation, for timing. That's so precise, it almost feels unfair. This is where your 3-layer radar becomes a weapon. Imagine this flow. On your high-level radar, let's say the 4-hour, you spot a pullback forming in an uptrend. The market is breathing, building. On your trading radar, the 15-minute, you see the pullback forming a flag or wedge. Structure is tightening. Liquidity is gathering. Now, switch to your execution radar, the 3-minute. You see it, a failure test. A false break below the flag base. A sudden wick. A sharp reclaim. That's the signal. That's the shot. You're not entering randomly. You're responding to context across all layers. HTF gives the backdrop. TTF shows the pattern. LTF triggers the entry. This is sniper logic, and it kills hesitation. Let's ground this with a real-world mission. February 2025, Tesla was pulling back after a strong earnings push from 195 to 218. On the 4-hour chart, a textbook bull trend was in place. Higher highs, higher lows. On the 15-minute, price started coiling into a descending wedge between 208 and 204. Many tried to anticipate the breakout and got chopped. But then, on the 3-minute chart, a false breakdown occurred. A clean sweep of the wedge base at 203.50, immediate reversal, volume spike, engulfing candle. That was the kill shot. Those who waited, they caught a move to 221 in under 2 hours. 17 pays and 50 points on Tesla. Those who jumped in early, whipsawed. frustrated, out of sync. Here's the beauty of this method. It removes the need for prediction. You don't need to guess when the flag will break. You wait for the market to fail, trying to go the other way. That failure creates imbalance, and imbalance creates movement. Your job isn't to know where the market is going, it's to know when the odds are no longer balanced. So next time you see a setup forming, don't rush. Ask, what is the higher time frame telling me? Is the pattern clean on the trading time frame? Has the lower time frame revealed intent through failure? Because when all three layers align, context, pattern, and trigger, your entry becomes more than just a guess. It becomes a response. And in trading, responders win, reactors lose. But even with this precision, you may still wonder, can I really build a system around this? Or is this just theory? Fair question. Let me walk you through a complete mission, real chart, real setup, full radar flow. Section 10, Live Mission Breakdown. Let's break down a real trade from radar to trigger so you can see how this all works in motion. March 2025, the market was watching Nvidia like a hawk. After weeks of consolidation post-earnings, something was building. On the surface, nothing dramatic. But under the hood, pressure was rising. Here's how the mission unfolded. High-altitude radar, the 4-hour chart. Nvidia was in a clear uptrend. Price had recently broken above a multi-week range at 880, then pulled back gently. Low volume, shallow retracement to 855, textbook bullish behavior. This wasn't a breakdown. It was a breath. The macro weather was clear. Mid-range radar, the 15-minute chart. A descending wedge was forming between 862 and 854. Each lower high came with weaker selling. Price coiled tighter. Volume compressed to 30% of average. The market was building a spring, but hadn't released yet. No entry, just observation. Low-level radar, the 3-minute chart. And this is where it got interesting. A sudden drop below wedge support at 854 swept early longs and panicked retail. A massive red candle to 851.50, but no follow-through. Then came the reclaim. One green candle, then two. A sudden surge in volume, 3x average. It was like watching a heartbeat monitor flatline, and then pulse back to life. That was the signal. Entry on the reclaim at 855. Stop just below the sweep wick at 850. Target back to the 4-hour highs at 880 and beyond. The move? Clean. Controlled. It didn't spike erratically. It flowed, like a current that finally found release. Exit at 8082, 27 points captured. This is how sniper trades are built. Not from luck, not from guessing. From alignment, structure, timing. And here's the part most traders miss. This trade wasn't about one candle. It wasn't about the wedge or the wick or the engulfing bar. It was about context layered across time. The 4-hour said, I'm trending. The 15-minute said, I'm coiling. The 3-minute said, I've shaken out the weak, now we go. That's how you build conviction without emotion. You don't need to feel brave. You just need to feel prepared. And when you train yourself to think this way, every trade becomes a mission. You don't stare at random charts hoping for luck. You scan your radar. You plan your approach. You wait. And when alignment shows up, you strike. But here's the twist. Sometimes the best mission is the one you never take. Because not every setup gets a clean trigger. Not every compression breaks in your direction. And not every day deserves your capital. Understanding when not to trade might be the most valuable skill of all. Section 11. The beauty of silence. There are days when the market whispers. Days when price moves slow, candles shrink, and everything feels muted, like someone turned the volume down on volatility. Most traders hate these moments. They crave movement, noise, direction. But the pros, they listen. Because in the silence lies clarity. Silence isn't absence. Silence is potential. It's the space before the thunder, the inhale before the scream. And when you learn to respect that space, you stop forcing trades just because you're bored. You start recognizing that waiting is a strategy, a powerful one. Let me give you an example. During the first week of April 2025, the market was frozen. CPI was coming. Big tech earnings were around the corner. Price chopped in tight ranges across the board. SPY moved 3 points total in 3 days. Twitter was dead. Discord channels were guessing. And most traders? They were poking at low-quality setups, trying to manufacture action where there was none. But one trader, Maya, did something different. She opened her charts, scanned her radar, and found nothing. HTF was unclear, TTF was disjointed, LTF was erratic. So she did nothing. For 3 days, 0 trades, 0 stress. Then came the breakout. A perfect HTF flag on Amazon at 178. LTF failure test at 177.20. Volume spike, 5x average. Everything aligned. She entered at 178.50 and caught a runner to 186. That one trade, 7.50 points, paid for the entire week. Here's the thing. Most traders would have missed it. Not because they didn't see the pattern, but because their capital and their attention were already burned out by bad trades from earlier in the week. This is the edge of silence. You preserve your firepower. You sharpen your focus. And when it's time to strike, you're ready. But silence isn't just about skipping. It's about listening deeper. During low volatility phases, structure builds. Liquidity pools form. Traps are laid. These are the moments where smart money prepares their moves. If you're rushing in, you become part of their liquidity. But if you're patient, you start to see what they're doing. You notice stops clustering under a tight range, repeated rejections from a level but with decreasing volume, wicks that probe liquidity zones but never follow through. These are whispers of intention, and they're only audible to those who aren't yelling over them with noise and overtrading. So ask yourself, do you have the discipline to sit in silence? Can you watch the market for hours or days without clicking the button? Because those who can win when others are spent. In trading, noise is temptation, but silence, that's signal. And when the silence breaks, you don't chase the move. You were already waiting at the breach point, calm, focused, dangerous. Think about it. How many of your worst trades happened because you were bored, because the market was too quiet and you needed action? If that hits home, you're not alone. But recognizing this pattern is the first step to breaking it. But even silence, even patience, means little if you don't know how to handle the psychological traps that come with multi-time frame trading. Like the most dangerous one of all, Section 12, the lie of higher time frame justification. This is going to sting a little, but it needs to be said. If you've ever held a losing trade while telling yourself, it still looks good on the daily, you're not trading a system. You're protecting your ego. Welcome to one of the most common psychological traps in trading, time frame justification. It happens when your setup fails on the time frame you entered on, but instead of cutting it, you zoom out. You look at the hourly, then the 4-hour, then the daily, and you find what you're looking for, a reason to hold. But here's the truth. Once you start switching time frames to defend your position, you've already lost. Because now, you're not trading with a radar. You're trading with a telescope that you point wherever your hope tells you to. Let me tell you about Jackson, a sharp trader who knew his edge. He traded the 15-minute tight entries, fast exits. But one week in January 2025, he broke his rules. He entered a QQQ breakout at 492. It failed, dropped to 489, and instead of taking the 3-point loss, he opened the 4-hour. It still looks bullish, he whispered. Then the daily, still above support. 2 days later, he was down at 478, minus 14 points. No exit, no plan, just hope wrapped in time frames. And when he finally cut it, he didn't blame the setup. He didn't blame the market. He blamed himself for violating the only thing that kept him grounded, focus. Your trading time frame is your command center. It's where you think, act, and evaluate. When you're in a trade, your only job is to operate within that layer. Zooming out in real time to justify pain is like a pilot ignoring engine failure by admiring the sky. It might feel better, but you're still crashing. But here's the twist. There's one exception. You can bump a trade to a higher time frame, but only when it's winning. When your 15-minute long is up 3R and the 1-hour shows more room, you can promote it. That's not justification. That's optimization. You're playing with house money, letting profits run. But when you're down and seeking rescue on a bigger chart, that's not strategy. That's fear wearing a headset. So here's your mirror moment. Do you cut your losses when your time frame tells you to? Or do you start chart surfing until you find a narrative you like? Because every time frame tells a story. But if you jump between them mid-trade, you're not reading the story. You're rewriting it to fit your bias. The best traders don't need hope. They have clarity. They know, if my time frame breaks, I'm out. No questions, no excuses. Because discipline isn't what you do when trades go well. It's what you do when they go wrong. So the next time your setup starts to bleed, don't zoom out. Zoom in to your rules. And remember, the only time frame that matters is the one you chose to risk on. Now that we've cleared that psychological trap, it's time to get practical. What if you built your own radar system, one that aligned your time frames, your triggers, and your psychology? Let's construct it together. Section 13, your personal radar build. This is where it all comes together. Until now, you've seen the terrain. You've walked through the fog, spotted the trapdoors, decoded the lies, and learned to wait in silence. But information isn't transformation, not until you build it into something you can use every single day. So, let's build your radar, your system, not someone else's setup, not another guru's checklist, yours. And it starts with one decision. What is your central command time frame? This is your anchor, your focus, your home base. It might be the 15-minute, it might be the 1 hour. Whatever you choose, this becomes the lens through which all your decisions are filtered. From there, pick your context layer, your high-altitude radar. If your trading time frame is the 15-minute, maybe your HTF is the 4 hour. This is where you identify trend strength, market phase, big zones. And below that, your execution layer. This is where you spot failure tests, liquidity sweeps, spring reclaims, the scalpel, not the sword. But don't stop at charts. To truly own your radar, you must answer 3 questions for each layer. What am I looking for here? Trend, structure, sentiment? What does alignment mean to me? Define it clearly. What signals tell me to stand down? Because not trading is part of the system. Let me show you how this worked for Arjun, a trader who had tried everything. He used to bounce between strategies, time frames, mentors, lost 85K in 2 years chasing volatility, avoided stillness, until one day he mapped his radar. 1 hour, trend phase, impulsive, corrective, or climax. 15-minute, structure, flags, wedges, compression. 3-minute, triggers, failure tests, engulfing reclaims, stop hunts. He built a playbook for each combination. When 1H was trending and 15M showed clean pullback, look for 3M failure test. When 1H was consolidating but 15M was spiking volume at edges, wait, or fade with small size. Everything had logic, boundaries, flow. He stopped second-guessing. He stopped chasing. And in 60 days, his win rate jumped from 38% to 64%. But more importantly, his peace did. Because that's the real goal of building your radar. Not more trades, not even more profits, but more clarity, more calm, more control. So here's your next step. Open your journal. Write down the 3 layers of your radar. For each one, define what it tells you. What qualifies as a green light? What means do nothing? And commit to this. When your system says wait, you wait. When it says fire, you act with zero hesitation. Because once you've built your radar, you stop looking for permission. You've got your own weather tower, and you know exactly when to fly. Personal challenge. This week, paper trade using only your 3-layer radar. No other indicators, no other opinions. Just your 3 time frames and the alignment rules you set. Track every decision. I guarantee you'll see patterns you never noticed before. Drop radar active below if you're committing to this. But now that you've claimed this clarity, there's one more deception we must destroy. A subtle one, a quiet one. It lives on your desk, in your browser tabs, and it's costing you more than you realize. Section 14, more data, more delusion. There's a myth in modern trading, seductive, dangerous, and everywhere. It whispers, if I just had more information, I'd finally win. So you open more tabs, more charts, more indicators. You start stacking screens like a command center, chasing the illusion of mastery. But the more you see, the less you know. Because data doesn't bring clarity, it brings complexity. And complexity kills precision. Let me be blunt. Most traders aren't underinformed. They're overstimulated. And when your brain is drowning in charts, conflicting signals, and contradictory time frames, you start trading from noise, not knowledge. Let me tell you about Diego. 6 monitors, 12 charts open. RSI on 5 time frames, volume profile, VWAP, market internals, Twitter feed on the side, Discord pinging every minute. He told himself he was being thorough, but his results, inconsistent. A countdown, 40% in 8 months. He'd talk himself out of good trades, talk himself into bad ones, and hesitate when clarity finally showed up. Why? Because he built a cockpit, but forgot how to fly. Here's the truth. The best traders don't use more data. They use better filters. They know what to ignore. They reduce the market into one decision per layer. Their radar doesn't show everything. It shows what matters. Do you really need to watch the 3-minute, 5-minute, 15-minute, and 30-minute all at once? Or are you just afraid to commit to a lens? Because commitment brings clarity, and clarity brings speed, and speed, with structure, brings precision. Let me give you a simple test. Pull up your chart. Now close everything that's not essential. Ask, what's my HTF structure right now? What's my TTF opportunity window? What is my LTF trigger pattern, and has it appeared? If you can't answer that in under 10 seconds, you're not trading from edge, you're trading from overload. The market rewards simplicity backed by depth, not depth that leads to paralysis. So, what's the fix? You go minimalist. One radar per layer, one lens per purpose, one decision per setup. Instead of 6 screens, maybe just one, with 3 tabs, 3 time frames, 3 intentions. And suddenly, your nervous system slows down. You start breathing with the chart instead of chasing it. You stop reacting to every candle and start responding to the ones that matter. Remember, every extra variable creates extra hesitation, and hesitation is the gap where fear enters. So ask yourself, are you building clarity or hiding behind complexity? Are you simplifying toward execution or stacking information as a delay tactic? Because once you strip away the excess, what's left is the real you, the real edge, the real decision. And that decision, made with precision, timing, and calm, that's what makes trading feel less like war and more like rhythm. And when rhythm takes over, something beautiful happens. You stop chasing the market, you start dancing with it. Here's something wild. The best trade I ever took used exactly 3 pieces of information: HTF trend, TTF pattern, LTF trigger. That's it. No indicators, no news, no opinions, just structure across time. Result, 12R in 4 hours. Simplicity isn't weakness, it's power. Speaking of power, let's talk about that feeling when everything finally clicks. There's a moment, and maybe you've felt it, when the chart opens and everything slows down. Not because the market is quiet, but because you are. You're not scanning with panic. You're not chasing the next candle. You're just watching, aware, centered. This is when trading becomes peaceful, not easy, not passive, but peaceful, in the way a master pianist plays a complex piece without tension. The fingers move fast, but the mind is still. And here's what you need to understand. That peace doesn't come from certainty. It comes from alignment. When your radar is clean, when your rules are defined, when your patience is stronger than your fear. Let me tell you about Hannah, a trader who used to white-knuckle every session. She jumped charts, rechecked every time frame, changed her plan mid-trade. Even when she won, she was exhausted. Monthly profit 3K, monthly stress through the roof. She told herself it was just the grind, the price of becoming great. But it wasn't. It was the cost of disconnection. She had knowledge, but no system. She had tools, but no structure. She had movement, but no rhythm. Until she simplified. 3 charts, 1 plan, 1 radar. She stopped trying to control the market and focused on listening to it. And then, it happened. Her trades didn't become perfect, but her decisions did. She knew why she entered. She knew when to exit. She slept better. She smiled more. And for the first time in years, she said, I don't feel like I'm gambling anymore. That's the shift. Trading becomes peaceful, not when you win every trade, but when you no longer need every trade to feel okay. When your process holds you like a safety net. When your losses are just data, not identity. When your edge isn't in predicting the future, but in reading the present clearly. That's what the 3-layer radar is all about. Not more charts, not more complexity, but deeper connection. Connection to structure. Connection to intention. Connection to your own psychology. And once you trade from that place, you stop searching for secret indicators. You stop asking for certainty. You start operating from clarity. So, let me ask you, When was the last time you traded with peace? Not excitement, not fear, but stillness? Because that stillness is where true performance begins. And if you've come this far, through the illusions, the failures, the chaos, the structure, then you're ready. Let me tell you something personal. 3 years ago, I was that guy with 6 monitors, burned out, frustrated, making money but hating every minute. Then I discovered what I've shared with you today. Now, 1 screen, 3 time frames, complete clarity, and the irony, my results tripled while my stress disappeared. You can have this too, but first, you need to take action. Your next mission starts now. You've just completed a journey most traders never even begin. You've seen the illusion of perfect setups. You've heard the whispers inside chop. You've decoded trapdoors, learned to wait through silence, and built your own 3-layer radar. You now understand that trading isn't just about pressing buttons. It's about perceiving layers, reading pressure, and moving only when the story aligns. So, now the real question is this. What will you do with this clarity? Here's your mission, simple but powerful. Choose your trading time frame. This is your command center. Own it. Define your high-level context layer. Is the wind at your back or in your face? Select your execution layer. This is where precision lives. Document your green light conditions. What must happen across all 3 to earn your trade? Commit to silence. If it's not aligned, you wait. No revenge, no improv, just calm. Now pause and breathe. Because if this video resonated, not just in your mind, but in your body, then you already know. This wasn't just education, it was recognition. You didn't learn something new, you remembered what deep down you've always known. The market isn't your enemy, your chaos is. And now that chaos has a name, and you have a radar. So here's what to do next. Comment below. I see the structure now. Let it be your signal, not to me, to yourself. Mark this as the moment you stopped reacting and started trading with vision. I read every comment, and I want to know who's ready to transform their trading. If you're ready for the next layer of clarity, subscribe and hit the notification bell. In the next video, we'll explore how volume profile becomes your 4th radar, letting you see not just when price is moving, but why. Trust me, it's going to blow your mind. And one final thought, the market doesn't punish those who are wrong. It punishes those who are blind. Now you see. Your trading will never be the same. Not because you learned a new strategy, but because you learned to see what was always there. Fly well, trader. We'll see you on the next mission. Remember, knowledge without action is just entertainment. Take what you learned today. Apply it tomorrow. Your future self will thank you. This is Trading Psychology Stick, signing off. What if I told you that the richest traders in the world started with absolutely nothing? Not small account, nothing. I mean zero, paper, fake money. And that's exactly why they won. Welcome to Trading Psychology Stick, the place where amateurs unlearn hype and rebuild themselves into traders who last. This isn't another trading tutorial. This is a psychological boot camp disguised as a YouTube video. Because the truth is, most people don't fail because of bad strategies. They fail because they never trained their brain. So if you're brand new, perfect. Because starting from zero means you have no bad habits to unlearn. You're an empty glass, ready to be filled. And today, we're going to fill it with process, precision, and pain-proof mindset. Quick disclaimer before we go deeper. This video is not financial advice. This is education for people who are tired of gambling and want to train like professionals. Trading carries risk, but so does staying where you are. If you commit to the full journey in this video, you'll walk away with something no course can sell you. A brain that thinks like the top 1%, even if your account still says $. Now let's start from where every legend began. Nothing but obsession, paper, and process. Chapter 1. The $0 start. Every guru screams, you need $25,000 to day trade. They're lying. Here's proof. The empty account advantage. When you have nothing to lose, you have everything to learn. An empty glass can be filled with pure water. A full glass can only overflow. Picture this. Tudor Jones, 28 years old, just fired from his job, sitting in a rented apartment, no Bloomberg terminal, no smartphone, no capital. Just a notebook and an obsession. Every single day, he'd run to the public library, copy stock prices from yesterday's newspaper, draw charts by hand, calculate moving averages with a pencil. Paper trading in the most literal sense. But here's what most people miss about paper trading. It's not just clicking buttons with fake money. That's a video game. Real paper trading is a business simulation. Before every single trade, you must write down 3 things. First, your thesis. I am buying here because X, Y, and Z. Second, your invalidation. If price breaks below this level, my thesis is wrong. Third, your target. My profit target is here based on this structural reason. At the end of each day, you don't review your fake P&L. You review your decisions. Did you follow your own rules? That's the only metric that matters. For 3 years, he traded fake money, tested every idea, lost imaginary millions, learned real lessons. Then, when he finally had $30,000 to trade, he was ready. The result? His fund gained 62% during Black Monday 1987. While Wall Street burned, he printed money. Why? Because money doesn't create good traders. Process creates good traders. And that process? It's free. Paper trading isn't pretending. It's your dojo, where samurai train before holding real swords. But here's the untold story about Paul Tudor Jones that changes everything. After his Black Monday triumph, reporters asked him, "What's your secret?" His answer? "I failed on paper 10,000 times before I succeeded once with real money." Think about that. 10,000 failures, each one documented, each one analyzed, each one teaching him what not to do. He had a failure journal, 3 columns. What I thought would happen, what actually happened, what I learned. By the time he put real money at risk, he'd already made every possible mistake. For free. The average trader loses $30,000 learning the markets. Jones lost $0. Who's smarter? Chris Camillo started paper trading in college. 0 capital. 3 years later, he turned 20K into 2 million. Not because he was lucky, because he was prepared. How many times have you said, "If only I had capital"? What if from today you stopped waiting for perfect conditions? What if you started with exactly what you have? Nothing but hunger. Your future self is watching you right now. What will you show them? But here's the dark truth about paper trading that nobody tells you. It doesn't prepare you for the emotional pain of a real loss. You know the money isn't real, and that's okay. Because the goal of paper trading is not to learn how to feel. The goal is to build a process so robust, so mechanical, so ingrained in your muscle memory, that when the emotional storm of real trading hits, your process becomes the lifeboat that you cling to. Paper trading builds your technique. Real trading tests your soul. Start with technique. Here's your paper trading drill for the next 30 days. Week 1, trade only one pattern. Document everything. Week 2, add position sizing rules. Never break them. Week 3, add time restrictions. Trade only 2 hours daily. Week 4, review all trades. Find your recurring mistakes. After 30 days, you'll have 100 plus trades documented. That's your foundation. That's your edge. Most people want to run before they can walk. Be different. Master walking. Chapter 2. The Casino Revelation. Trading isn't gambling. If you understand this one mathematical fact, that casinos pray you never learn. The house edge flip. Casinos win with a 51% edge. Traders win with the same edge. But there's a catch. Let me tell you about Edward Thorpe, MIT professor, 1962. He walked into Vegas casinos with a notebook full of equations. Security watched him like a hawk. Pit bosses sweated. Because Thorpe had done the impossible. He'd mathematically proven how to beat blackjack. His edge, 51%. Casinos panicked, changed rules. Banned him from every establishment in Nevada. So Thorpe laughed and took his formulas to Wall Street. Same math, same 51% edge, different game. The result? His hedge fund never had a losing year, not once in 20 years. But here's the part of Thorpe's story they don't tell you in the movies. Before he ever placed a real bet, Thorpe played 100,000 hands in his mind. He'd deal cards to himself in his office, track every outcome, calculate probabilities. He discovered something profound. The edge only works if you survive long enough for probability to play out. One bad bet with too much capital, dead. Even with an edge, his rule, never bet more than 2% of capital. even with 51% edge, even when he knew he'd win. Why? Because knowing and proving are different things. Probability needs time. Time needs survival. Survival needs small bets. Here's what casinos understand that most traders don't. You don't need to win every hand. You need to win $110 when you're right and lose $100 when you're wrong. Do that 1,000 times, you're rich. It's not magic, it's math. The casino doesn't cry when someone wins a hand. They know the edge plays out over time. But you panic after one loss. Here's the math that made Thorpe billions. Kelly criterion, bet size equals edge divided by odds. If you have 10% edge with even odds, bet 10% of capital. If you have 5% edge with even odds, bet 5% of capital. If you have 0% edge, bet nothing. Most traders bet 50% with no edge, then wonder why they're broke. Think about your last losing trade. Did you feel that stomach punch, that urge to win it back? That's not trading, that's gambling. What if you saw losses like a casino does? Just operating expenses, cost of doing business? What if you became the house? But here's the hidden truth about the casino model. Casinos have one advantage you don't. They can ban winners. You're competing against other traders who also know the edge. It's not casino versus gamblers. It's shark versus shark. The real edge isn't mathematical. It's psychological. It's doing what the math says when every fiber of your being screams otherwise. Can you place the 500th trade with the same discipline as the first? That's the real question. But to become the house, first you need to understand your biggest enemy. And it's not the market. Chapter 3. Your brain is the enemy. Your brain is 150,000 years old. The market is 400 years old. Guess which one is winning? The Savannah Paradox. Your brain thinks every red candle is a lion attacking. 150,000 years ago. Serengeti Plains. Your ancestor hears rustling in the grass. Fight or flight. Adrenaline floods. Heart hits 180 BPM. Pupils dilate. Muscles tense. Wrong equals death. Right equals survival. Fast forward, 2025, 9:31 a.m., you, staring at your screen, red candle appears. Exact same biological response. Your brain screams, danger, run. You panic sell. The bottom. Price bounces. You punch your keyboard. Here's the thing. It's not your fault. It's evolution's. But here's the neuroscience they don't teach you. Your amygdala, the fear center, processes information 12 milliseconds faster than your prefrontal cortex, the rational center. You literally feel before you think. In the savannah, this saved your life. In the market, it destroys your account. The solution isn't to fight your biology, it's to hack it. Mark Douglas spent 20 years studying trader psychology. His discovery? Great traders don't conquer emotions. They rewire biological responses. Red candle isn't a lion, it's a data point. Stop loss isn't failure, it's insurance. Losing trade isn't death, it's tuition. Navy SEALs use box breathing to override their amygdala in combat. Traders can too. Inhale 4 seconds, hold 7 seconds. Exhale 8 seconds. Do this before every trade. Your reptilian brain calms. Your prefrontal cortex takes control. But box breathing is your first aid kit. For long-term rewiring, you need to create a trading persona. Give your ideal trading self a name. The executor, the sniper, the process machine. Before a trading session, you perform a small ritual. Put on a specific hat, listen to a specific song, and you become that persona. The executor doesn't feel FOMO. He doesn't revenge trade. He just follows the rules. This psychological separation between you and the trader is the secret weapon of the pros. It creates a buffer against your 150,000-year-old brain. Here's a 7-day brain rewiring challenge. Day 1 to 2, the observer phase. Sit with charts for 30 minutes. Do not trade. Just observe your thoughts. Write down every urge. Wanted to buy here because you're mapping your impulse patterns. Day 3 to 4, the narrator phase. Watch price action and narrate like a sports commentator. Price approaching resistance, buyers showing exhaustion, sellers entering. You're building objective observation skills. Day 5 to 6, the robot phase. Paper trade with one rule. No trade without 60 seconds of box breathing first. Feel the difference between impulse and decision. Day 7, the integration. Review all your notes, you'll see your patterns, your triggers, your weaknesses. Congratulations. You just completed Trader Psychology 101. Most people pay $5,000 for this in a seminar. You just got it free. Because knowing isn't the problem, doing is. Remember your last FOMO buy at the top or panic sell at the bottom. That wasn't weakness. That was your brain doing exactly what 150,000 years of evolution programmed it to do. Question is, will you stay a slave to ancient wiring, or will you evolve? But evolution requires awareness of the predators. Speaking of which, let's talk about the ones hunting you in these markets. Chapter 4. Spot the inside men. In 2020, the FTC exposed traders making millions, who had never placed a real trade. Here's how the scam works. The signal seller paradox. If someone could print money trading, why would they need your 97s? Meet Trader Bro Fiore69, real name, Kyle, from Ohio. Every morning, he posts Lamborghini pics, made $50K before breakfast, Dubai penthouse views, private jet selfies. His course, only $9.97. Learn my secret strategy. One problem, Kyle's never traded, ever. That Lambo, rented for $500, penthouse, Airbnb, trading screenshots, Photoshop, his actual income, your course payments. But here's the deeper psychology of why you fall for it. Your brain is wired for social proof. When you see lifestyle images, your mirror neurons fire. You literally feel yourself in that Lamborghini. Scammers know this. They're not selling trading education. They're selling dreams. The formula is predictable. Display wealth, usually rented. Show proof, always edited. Create urgency, only 10 spots left. Price anchor, usually $5,000. Today only 997s. Risk reversal, 30-day guarantee. Your emotional brain is screaming, what if this is real? What if I miss out? Your logical brain is drowned out. In 2020, the FTC shut down 17 similar operations. Combined victim losses, $231 million. But here's the deeper scam. Even legitimate signal services are selling you garbage. Why? Because edges expire. If 10,000 people trade the same signal, the edge vanishes. It's like giving everyone the same treasure map. First person gets gold. Everyone else gets dirt. Real traders guard their edge like nuclear codes. They don't sell it for 97. Here's a secret from a hedge fund trader. We spend millions developing strategies. If one leaks, we burn it immediately. A public edge is a dead edge. Think about it. Renaissance Technologies, the most successful fund ever, makes employees sign lifetime NDAs. One strategy leak, sued into oblivion. But Trader Bro 469 will teach you his secret strategy for 3 easy payments. Right. How many courses have you bought? How many signals have you followed? How many made you rich? What if the real secret is there is no secret? What if success is just math, discipline, and time? What if everything you need is free, and everyone selling you secrets is the real enemy? Here's how to spot the fake gurus instantly. 1. They talk more about lifestyle than process. 2. They show profit screenshots but never losses. 3. They have limited time offers every week. 4. They promise specific returns, make $5K per week. 5. They never show multi-year audited results. Real traders, they're boring. They talk about risk management, not Lamborghinis. Now, let's talk about the only edge that actually matters, and it's been hiding in plain sight for 60 years. Chapter 5. The Mathematical Edge. This math formula made a professor persona non grata in every casino. Then he used it to get rich on Wall Street. The 51% revolution. You don't need to be right often. You need to be right profitably. Edward Thorpe, MIT, teaching probability to bored students. Imagine, he said, you could flip a coin where heads pays $3 and tails costs you $1. Students perked up. Would you play? Obviously. Congratulations. You just understood how every casino on Earth makes money. But Thorpe went further. He proved you could reverse engineer the edge. Turn yourself into the casino. Blackjack, card counting, 51% edge. When Vegas banned him, he thought, where else do probabilities rule? The stock market. His Princeton Newport Partners Fund used the same principle. Small edge. Many trades. Let math work. Result? 227 months of trading, 226 profitable. The one loss, 0.5%. Average annual return, 19.1% for 20 years straight. Here's your $1 million math lesson. Win, rate times, average. Win minus loss. Rate times average loss equals edge. Example, win 45% of trades at 3-to-1 reward. Lose 55% of trades at 1x risk. Edge equals 0.45 times 3 minus 0.55 times 1 equals 0.8. You're losing more than winning, still profitable. But here's what they don't teach in probability class. The edge isn't just mathematical, it's psychological. Every time you take a trade with positive expectancy, you're doing something 99% of humans can't do. You're accepting a probable loss for a possible gain. Think about that. Your brain screams, "This might lose," and you reply, "I know, that's part of the plan." This is why lottery tickets sell billions despite negative expectancy. People prefer improbable wins over probable losses. You're training yourself to think opposite to human nature, to embrace probable losses as the cost of inevitable gains. That's the real edge, not the math, the mindset that lets you execute the math. Here's Thorpe's actual trading process. Find inefficiency, the edge. Calculate optimal position. Size, Kelly criterion. Execute without emotion. Track results obsessively. Adjust or abandon based on data. No opinions, no predictions, no hope, just math. This is why amateur traders fail. They chase 90% win rates. Pros chase positive expectancy. You've been taught your whole life, more correct answers equals better grade. In trading, wrong 55% of the time can make you rich. Here's the expectancy calculation that changed my life. My system, 40% win rate, 1.3 risks at reward. Expectancy equals 0.40, x3 minus 0.60, x1 equals 0.60. Every trade has positive expectancy of 0.60 R. Take 100 trades plus 60 R expected. Lose 60 times, win 40 times. Still profitable. Can your ego handle being wrong more than right? If not, you'll join the 95% who fail. What matters more to you, being right or being rich? But knowing the math is useless if you can't read the language of the market. Let me decode it for you. Chapter 6, The Chart Whisperer. After staring at charts for 50,000 hours, you start seeing things others can't, like this. The river map method. Charts aren't random, they're conversations between titans. Peter Brandt, trading since 1975. No indicators, no algorithms, just price. I asked him once, "How do you see what others miss?" He pulled up a chart, drew 3 lines. See this? Line 1, that's the river, where price wants to go. Line 2, that's the boat, where we can jump on. Line 3, that's the anchor, where we admit we're wrong. Everything else is noise. So, what are these 3 lines? Think of it this way. Line 1, the current. This is the dominant trend on a higher time frame, like the daily chart. Is the river flowing up or down? Line 2, the raft. This is your entry point on your execution time frame, like the 4-hour chart. It could be a clear support level, a breakout from a consolidation pattern. It's where you can safely get on the current. Line 3, the anchor. This is your stop loss, placed at a point where the entire structure of the trade breaks. If the anchor is hit, the raft is sunk, and you get out. The market is flowing, you find a raft, and you have an anchor. That's it. That's the trade. But here's what Brandt didn't tell the interviewers. Those 3 lines took him 20 years to see clearly. First 5 years, he saw 50 lines, all important, all confusing. Next 5 years, he saw 20 lines, getting clearer. Next 5 years, he saw 10 lines, almost there. Final 5 years, he saw 3 lines. Mastery. Leonardo da Vinci said, "Simplicity is the ultimate sophistication." In trading, simplicity isn't where you start, it's where you arrive. In 2020, he called Bitcoin's move from 10K to 60K. 3 lines, that's it. 600% gain, 3 lines. While others drew 47 indicators, Brandt drew 3 lines and went to play golf. Markets speak a simple language. Big green candles equal institutions buying. Round numbers equal algorithm targets. Gaps in price equal unfilled orders. Repeated tests equal building pressure. But here's the advanced chart reading nobody teaches. Volume tells you who is trading. Price tells you what they're doing. Time tells you how confident they are. High volume, small price move, accumulation or distribution. Low volume, big price move, weak hands folding. Sideways price, declining volume, coiling spring. The chart isn't just showing price, it's showing psychology, fear, greed, capitulation, euphoria. Learn to read the emotions, not just the candles. You don't need to predict, you need to listen. The chart is telling you, banks are buying here, sellers are trapped there, pressure is building. All you do is position yourself before the dam breaks. How many indicators are on your chart right now? 5, 10, 20? What if each indicator is just noise drowning out the market's actual voice? What if simplicity isn't just better? What if it's the only thing that works? Could you delete everything and trade with just 3 lines? But even perfect analysis is worthless without the element most traders discover too late. Chapter 7. The Time Arbitrage Secret. I'm about to show you why day traders drive Toyotas while swing traders drive Teslas. The time frame tax. The lower you go, the more you pay, in stress, mistakes, and losses. Meet Jake, day trader, 15 monitors, IV drip of Red Bull, wakes at 4 a.m., trades every tick, 50 trades a day, burnt out by noon, annual return down 12%. Meet Sarah, swing trader, 1 laptop, coffee at 9 a.m., checks charts for 20 minutes, places 1 trade, goes to yoga, annual return up 47%. The difference? Jake fights in a knife fight, the 1-minute chart. Every algorithm, every bot, every HFT firm is his enemy. Sarah plays chess, the 4-hour chart. She waits for the obvious moves, the ones institutions telegraph days in advance. But here's the mathematics of why lower time frames destroy accounts. The spread tax. On a 1-minute chart, spread eats 50% of your average move. The noise ratio. 90% of 1-minute moves are meaningless noise. The decision fatigue. 50 decisions daily versus 2 decisions weekly. The stress compound. Cortisol levels spike every losing tick. It's not that you can't make money day trading, it's that the cost is exponentially higher. Like mining gold with tweezers instead of an excavator. Possible? Yes. Smart? No. Nikola Darvas made millions trading while touring the world as a dancer. His secret? He only looked at daily charts, sent telegram orders to his broker, checked positions once a week. The money is made in waiting, not trading. Higher time frames equal clearer signals, less noise, fewer mistakes, better sleep. Your edge isn't speed, it's patience. Here's the time frame profit matrix I discovered. 1-minute chart, 95% lose money. 5-minute chart, 90% lose money. 1-hour chart, 70% lose money. 4-hour chart, 60% lose money. Daily chart, 40% lose money. Weekly chart, 20% lose money. Notice the pattern: higher time frame, higher success rate. Why? Because institutions can't hide their footprints on higher time frames. A manipulation on 1 minute is invisible on daily, but accumulation over weeks, crystal clear. Be honest, are you addicted to the action, the adrenaline of quick trades? That's not trading. That's gambling with extra steps. What if the path to wealth is more boring than you imagined? What if boring is exactly what makes you rich? Can you handle getting rich slowly? Here's your time frame transition plan. Week 1 to 2, your current time frame. Week 3 into 4, 1 time frame higher. Week 5 into 6, 1 more time frame higher. Week 7 into 8, compare results. I guarantee higher time frames equals higher profits. The only question is whether your ego can handle less action. Once you've got the right time frame, you need to know where the big money hides. And I'm about to expose their favorite hiding spots. Chapter 8. The Supply and Demand Masterclass. Goldman Sachs can't buy 10 million shares without you noticing, if you know where to look. The warehouse theory. Big money doesn't chase price. They build positions in zones. Paul Tudor Jones, billionaire trader, once said something that changed my life. I don't trade markets. I trade market participants. What did he mean? Watch, right here. Price goes sideways for 3 days. Boring, right? Wrong. That's Goldman Sachs accumulating, slowly, quietly, building their warehouse. Then, boom, price explodes up 15%. Retail traders. Where did that come from? Tudor Jones. Exactly where I expected. Here's a secret from a former Goldman trader. We had a saying, build in the shadows, reveal in the light. They accumulate when nobody's watching, pre-market, after hours, during lunch, when retail is distracted by other shiny objects. The accumulation phase has 3 stages. Stage 1, the shakeout. They push price slightly below support, trigger stop losses, create fear. Stage 2, the absorption. They buy everything. Every sell order gets absorbed. Price goes nowhere. Volume surges. Stage 3, the spring. A final push down, the ultimate bear trap, then explosion. If you see all 3 stages, the move is coming. It's not prediction, it's pattern recognition of institutional behavior. Watch any major breakout. You'll see this pattern every single time. Every major move starts the same way. Accumulation, markup, distribution, markdown, find the warehouses, front-run the institutions. Institutions can't hide. They're too big, like whales in a swimming pool. Look for high volume plus flat price equals accumulation. Break of structure equals direction confirmed. Retest of zone equals your entry. Stop outside, zone equals protection. But here's the advanced supply and demand nobody teaches. Not all zones are equal. Quality matters. Fresh zones, untested, maximum power. Tested zones, weakened. Approach with caution. Multiple test zones, dead. Avoid completely. The best zones have 3 characteristics. 1. Strong move away, explosive, not gradual. 2. Clear consolidation before the move. 3. Untested, fresh ammunition. Find zones with all 3. That's where institutions have unfinished business. You're not predicting, you're following footprints. Giant billion-dollar footprints. You've been trying to outsmart the market, but what if you just need to follow the smart money? They leave clues everywhere. Are you paying attention? Or are you too busy drawing trend lines on noise? Now here's where it gets interesting. You don't need $1 million to trade like you have $1 million. Chapter 9, the leverage multiplier. Banks use 30-to-1 leverage and get bailed out. You can use 10-to-1 leverage and get rich, if you're not an idiot. The dynamite principle. Leverage isn't dangerous. Stupidity with leverage is dangerous. Long-term capital management. Dream team, 2 Nobel Prize winners, 16 PhDs. Combined IQ, unmeasurable. Position size, 25% per trade. Leverage, 100-to-1. We've solved the market, they said. Our models can't fail. August 17th, 1998. Russia defaults. In their models, impossible event. In reality, happening right now. Imagine the silence in that room full of PhDs. Their beautiful Nobel Prize-winning models on the screen were screaming, this event has a 0 probability of happening, while their P&L statement was bleeding billions by the hour. In that moment, they learned the market doesn't care about your IQ. It doesn't care about your credentials. It is a force of nature, and it will humble anyone who believes they have solved it. 4 weeks later, $4.6 billion becomes $0. But here's what the documentaries don't tell you about LTCM's collapse. John Meriwether, the founder, didn't disappear. He started a new fund, same strategies, lower leverage, the result, profitable for 10 years straight. The strategies weren't wrong. The leverage was. It's like driving. A Ferrari isn't dangerous. A Ferrari at 200 mph in a school zone is dangerous. LTCM drove their Ferrari at 200 mph. Meriwether learned to cruise at 100 mph. Same car, different outcome. This is the leverage paradox. The same tool that destroys amateurs creates wealth for professionals. The difference isn't the tool, it's the temperance. Warren Buffett uses leverage. Ray Dalio uses leverage. Every hedge fund uses leverage. They just don't use stupid leverage. Meanwhile, a trader named Tom Basso uses 10-to-1 leverage, 1% risk per trade, 30 years, never blown an account, quietly compound millions. Who's smarter? Leverage is a tool, like a chainsaw. Used right, build a house. Used wrong, lose a hand. Rules for survival: never exceed 10-to-1. Always calculate position size first. Stop loss is non-negotiable. Treat leverage capital like it's your kidney. Here's the position sizing formula that saved my account. Position size equals account risk x account balance. Stop distance x leverage. Example, $10,000 account 1% risk equals 100. 20 pip. Stop 10.1 leverage position size equals 100, or 20 pips x 10 equals 0.5 lots. Simple math. Saves lives. One mistake with 100 to 1 leverage equals game over. 1,000 wins with 10 to 1 leverage equals generational wealth. That voice saying, but 10 to 1 isn't enough. I need 50 to 1 to get rich fast. That's not ambition talking. That's greed. And greed with leverage equals bankruptcy. Can you build wealth at boring speeds? Or will you blow up chasing thrills? Leverage gives you firepower, but without the right daily routine, you're shooting blind. Chapter 10. The Morning Ritual Blueprint. What Ray Dalio does before 6 a.m. made him $20 billion. Want to know his morning secret? The pre-battle protocol. Wars are won before breakfast. Ray Dalio, founder of the world's largest hedge fund. Every morning, same routine. 40 years. 5 a.m., wake, no snooze, ever. 5:15 a.m., meditation. 20 minutes, non-negotiable. Meditation is the single most important thing I do, he says. 5:35 a.m., journal, 3 pages, stream of consciousness. 6 a.m., market prep, economic calendars, key levels, no opinions, just data. 6:30 a.m., exercise. If you can't manage your body, you can't manage money. 8 a.m., first trade consideration, clear mind, zero emotion. By the time markets open, Dalio has already won. But here's what Dalio doesn't publicize. His journal isn't random thoughts. It's structured. Page 1, gratitude, 3 things. Prime's abundance mindset. Page 2, visualization. Perfect trades executed flawlessly. Page 3, concerns. Write them down, then let them go. This isn't woo-woo, it's neuroscience. Gratitude activates the prefrontal cortex. Visualization creates neural pathways. Writing concerns externalizes anxiety. He's literally rewiring his brain before touching a single trade. Your morning routine is your edge. While others wake up and immediately check losses, you're preparing like a professional athlete. Trading isn't about the 30 minutes you spend executing. It's about the 3 hours of preparation that make those 30 minutes profitable. My non-negotiables: cold shower for alertness, no phone for first hour for focus. Write 3 trade ideas for clarity. Visualize perfect execution for confidence. But here's the advanced morning routine nobody talks about. The market pregame checklist. 1. Check economic calendar, what bombs could drop. 2. Note key levels on your instruments. 3. Read zero news, opinions cloud judgment. 4. Review yesterday's trades, what worked, didn't. 5. Set daily loss limit, your kill switch. 6. Write your if-then scenarios. Example, if EUR/USD breaks 1.1050, then I enter long with stop at 1.1030, pre-decided, emotionless, robotic. What's your morning? Snooze until 8:58, coffee, then panic trade at 9:30? That's not trading, that's reacting. What if you gave yourself the gift of preparation? What if you showed up like a pro instead of an amateur? Tomorrow morning, you choose. But even the perfect morning routine won't save you from the graveyard of failed strategies. Chapter 11. The Strategy Graveyard. I spent $47,000 on trading strategies. Want to know which one actually worked? The strategy hopping disease. The problem isn't your strategy, it's your impatience. My trading journey. Year 1, moving average crossovers. This is it. Lost 10K. Year 2, Fibonacci retracements. Now this is it. Lost 15K. Year 3, Elliott wave. Complex must be better. Lost my sanity. Year 4, harmonic patterns. The geometry of markets. Lost 20K. Year 5, supply and demand. Simple. Wait, this works? 47,000 in education. The lesson? Every strategy works. For someone, somewhere, sometimes. But here's the controversial truth nobody admits. Your failed strategies weren't failures. They were education. Moving averages taught you trend dynamics. Fibonacci taught you market structure. Elliott wave taught you market psychology. Harmonics taught you pattern recognition. You paid $47,000 for a trading university education. Each strategy was a different course. Now you trade supply and demand, but you see it differently than someone who started there. You see the moving average dynamic within the zone. You notice the Fibonacci relationships. You feel the Elliott wave psychology. You recognize the harmonic structures. Your simple strategy isn't simple. It's sophisticated simplicity, the kind that only comes from complexity distilled. Steve Jobs said, "Simple can be harder than complex." You have to work hard to get your thinking clean to make it simple. Your journey through complexity wasn't wasted. It was necessary. To achieve mastery, you first had to explore everything. Now you trade one setup, but you trade it with the wisdom of someone who's seen it all. The question isn't, what's the best strategy? The question is, what strategy can I execute for 10,000 hours without going insane? Bruce Lee said, "I fear not the man who practiced 10,000 kicks once, but the man who practiced one kick 10,000 times." Trading translation, master one setup. My bread and butter, fair value gap entry. Previous high-low target. Structure low stop. 1 to 3 minimum reward. 10,000 repetitions later, I see this setup in my sleep, and it prints money. But here's the strategy secret that will save you $47,000. Every profitable strategy has 5 components. 1. Entry trigger, clear and objective. 2. Stop loss, predetermined. 3. Target, logical. 4. Position size, mathematical. 5. Management, rules-based. Missing any component, the strategy fails. Not because it's wrong, because it's incomplete. How many strategies have you tried? How many YouTube videos searching for the Holy Grail? What if the Holy Grail is just doing one simple thing, over and over, until it's automatic? Can your ego handle that simplicity, or do you need complexity to feel smart? One setup, one edge, executed perfectly. But perfect execution is impossible without managing this. Chapter 12. The emotional bankroll. I track my emotional state like a trader tracks P&L. Green days, yellow days, red days. Red days, I don't trade. Period. The tilt tracker. Your emotions have a bankroll too. Blow it and money follows. Ever heard of Stu Ungar? Greatest poker player ever. Won millions. Died broke in a cheap motel. Why? Tilt. When he lost, he'd double down, triple down, mortgage the house down. His skill was legendary. His emotional control was zero. Sound familiar? Loss, Monday. I'll make it back Tuesday. Bigger loss. Tuesday, Wednesday's my day. Disaster. Wednesday, time for revenge. Account blown Thursday. I've been there. We all have. Until I started tracking emotions like positions. My emotional trading journal, green, calm, patient, following rules. Yellow, anxious, rushing, bent rules. Red, angry, desperate, breaking rules. Rule, no red day trading. Ever. 0 exceptions. Result, haven't blown an account in 5 years. This tilt tracker isn't just about feelings. It's about your nervous system. A green day means you're in a parasympathetic state. Rest and digest. You're calm, rational, creative. A red day means your sympathetic nervous system has taken over. Fight or flight. Your blood flows from your prefrontal cortex, rational thought, to your limbs. You are physiologically incapable of making good financial decisions in this state. The market doesn't know you're angry, but your body does. Not trading on a red day isn't weakness. It's respecting your own biology. Here's the advanced emotional management system. The HALT check. Never trade when you're hungry. Low blood sugar equals poor decisions. Angry, emotional hijacking. Lonely, seeking validation through wins. Tired, impaired judgment. Before every session, rate yourself 1 to 10 on each. Below 7 on any, no trading. But here's what changed everything for me. The 24-hour rule. After any losing day, mandatory 24-hour break. Not because you can't win tomorrow, because you need perspective. Every blown account starts with, I'll just take one more trade to get back to break even. That one more trade is Russian roulette. But I'm leaving money on the table. No, you're leaving dynamite unexploded. After your last big loss, what did you do? Be honest, did you immediately try to win it back? Did you increase position size, break your rules? That's not trading, that's self-destruction with extra steps. What if you had a kill switch? What if red days meant stepping away, not stepping up? Managing emotions is defense. Now let's talk offense. How to spot the setups that actually pay. Chapter 13. The market maker's playbook. Market makers aren't your friend, they're hunting your stops. Here's how to avoid becoming prey. The stop hunt safari. They know where you put stops, so put them where they don't expect. Watch this. Every single time. Support at $100. Where does everyone put their stop? $99. The market drops to $98.97, triggers all stops, then immediately reverses to $105. Manipulation, traders scream. No. Business. Market makers need liquidity. Your stops are liquidity. They're not evil, they're efficient. Fun fact, there's a former market maker on Reddit who revealed their playbook. His confession. We had heat maps showing exactly where retail stops clustered. It looked like a Christmas tree, bright red zones at obvious levels. Our job was simple. Push price to the red zones, collect liquidity, let price return to value. The most profitable zones, round numbers -1 cent, previous day low -1 cent, 50% retracements exactly. We called it stop hunting season, not because we were evil, because it was predictable, like fishing where the fish always gather. His advice? Place stops where it hurts. If it feels comfortable, you're in the cluster. If it feels too far, you're probably safe. The market maker's edge isn't sophistication. It's exploiting human predictability. Be unpredictable. The pattern never changes. The victims never learn. Stop loss. Invisibility cloak. Don't place at recent low -0.1. Do place at market structure break. Don't use round numbers like 99s. Do use ugly numbers like 98.73. Don't follow the herd. Do follow the logic. But here's the advanced stop placement strategy. The ATR method. 1. Calculate average true range, ATR. 2. Multiply by 1.5. 3. Place stop that distance from entry. 4. Never at obvious levels. This puts your stop beyond normal volatility, but inside your risk tolerance. Market makers hunt obvious stops. Be non-obvious. Where's your stop loss right now? Let me guess. Right below support? Congratulations, you're on the menu. What if you started thinking like the hunter, not the hunted? What if you put stops where logic dictates, not where everyone else does? Avoiding the hunters is step 1. Step 2 is understanding the magical math of compound growth. Chapter 14. The Compound Effect. Einstein called compound interest the eighth wonder of the world. Watch what happens when you apply it to trading. The snowball system. Small gains, massive dreams. Let me blow your mind with basic math. Start, $1,000. Daily goal, 1%. Trading days, 220 per year. End of year, 1, $9,000. End of years, 2, $81,000. End of year, 3, $729,000. Impossible, you say. You're right. So, let's get real. Let's be brutally honest about that 0.5% daily average. That is not a smooth lineup. In reality, it looks like this. Plus 2%, minus 1.5%, plus 0.5%, minus 1%, minus 1.2%, plus 3%. It's a violent, jagged journey upward. The number is an average over hundreds of trades. The real magic isn't in the compounding itself. It's in having the risk management and emotional fortitude to survive the vicious drawdowns that are a guaranteed part of the journey. Most people quit during the first drawdown. The 1% survive it. Here's what a real equity curve looks like. Month 1, up 5%. Month 2, down 3%. Month 3, up 8%. Month 4, down 6%. Month 5, up 12%. Month 6, down 2%. 6 months, up 14%. Not smooth, not easy, but profitable. That's reality. Accept it or quit now. 0.5% daily average accounting for losses. Year 1, $3,000. Year 2, $9,000. Year 3, $27,000. Still triple your money annually, still life-changing. Warren Buffett averaged 20% per year and became the richest investor alive. You can average 100% per year as a skilled trader. The difference? Time in the game. The compound mindset shift. Stop thinking, I need to make 10K this month. Start thinking, I need to survive and compound for 10 years. My actual progression. Year 1, 1K becomes 3K. Learning, surviving. Year 2, 3K becomes 15K. Finding edge. Year 3, 15K becomes 60K. Consistency. Year 4, 60K becomes 250K. Scaling. Year 5, 250K becomes $1 plus. Mastery. Slow? Yes. Millionaire? Also yes. But here's the compound secret nobody tells you. The biggest threat to compounding isn't losses, it's withdrawals. Every time you withdraw for bills, toys, or flexing, you reset the compound clock. 10K growing at 100% yearly. Year 5, 320K. 10K growing at 100% yearly, with 5Ks withdrawn annually. Year 5, 85K. Same returns, 1/4 the result. The compound equation has 3 variables. 1, principal, starting amount. 2, rate, your edge. 3, you control all 3, but time is the most powerful. You want the year 5 results with year 1 experience. Life doesn't work that way. Markets definitely don't. Can you embrace the journey? Can you fall in love with the process, not just the profits? If not, you'll quit in year 2, like 95% do. Compound growth is powerful, but first, you need to find trades. Let me show you exactly how. Chapter 15. The Scanner System. 40,000 tradable instruments. You need 3. Here's how to find your 3. The needle finder. More choices equal more mistakes. Less is literally more. New traders screen, 47 charts, 200 watch list items, 15 time frames. Result, analysis paralysis, missed opportunities, bad trades. My screen, 3 charts, 10 watch list items, 2 time frames. Result, clarity, precision, profits. How I filter 40,000 down to 3. Monday, scan top 20 volume movers. Tuesday, identify clean trends. Wednesday, mark key levels. Thursday, wait for setups. Friday, execute best 2 to 3. That's it. That's the whole system. The focus filter. F for flowing, trending clearly. O for obvious, levels jump out. C for clean, no choppy action. U for upcoming, approaching key levels. S for simple, grandma could trade it. Let's run a live example of the focus filter. Look at this chart of asset XYZ. F for flowing? Yes, clear uptrend on the daily. O for obvious. Yes, there's a huge obvious resistance level at $100 that's been tested 3 times. C for clean? Yes, the price action isn't a chaotic mess. It's moving with clear impulse and correction waves. U for upcoming? Yes, it's currently at $98, approaching that key level. S for simple. The thesis is dead simple. If it breaks $100 with conviction, it's likely to run hard. This asset passes the filter. All other 40,000 instruments, I don't care about them today. But here's the scanner secret that took me years to learn. The best trades aren't found, they find you. When you focus on 3 instruments for months, you develop intuition. You know their personality, their rhythm, their tendencies. EUR/USD at 1/1000? You've seen this movie before. Gold at resistance? You know exactly how it behaves. S&P at all-time highs? You've traded this pattern 50 times. Expertise beats variety. Every time. Bruce Lee. I don't fear the man who practiced 10,000 kicks. I fear the man who practiced 1 kick 10,000 times. Trading translation. Master 3 instruments completely rather than know 100 superficially. If it doesn't pass all 5, it's not a trade. Quality over quantity. Always. How many screens do you have open right now? How many indicators? How many watch lists? What if overwhelm is killing your profits? What if less really is more? Could you trade just 3 instruments for a month? Could you master them completely? You've got your 3, you've got your setup, but nothing prepares you for the emotional tornado of real losses. Chapter 16. The Failure Museum. I'm about to show you 150,000 worth of mistakes, for free. You're welcome. Welcome to my Museum of Failure. Admission is free. The lessons cost me everything. The tuition invoice. Every master paid it. The question is, will you learn from it? Exhibit A. The no-stop loss disaster. Date, March 2017. Loss, down $45,000. Lesson, It'll come back is not a strategy. The full story, Tesla earnings. I was sure they'd beat. Bought calls, no stop. Earnings missed, stock tanked. I held. It's oversold. It'll bounce. It didn't. Options expired worthless. 45K gone in 3 weeks. The real lesson? Being right about direction means nothing if you're wrong about timing. Exhibit B, the averaging down apocalypse. Date, June 2018. Loss, down $30,000. Lesson? Adding to losers is like drinking poison and expecting the market to die. The psychology, down 5K. Great cheaper prices, added more, down 10K. Even better value, added more, down 20K. It has to turn here, all in, down 30K. Account blown. Averaging down feels smart. It's actually doubling down on being wrong. Exhibit C, the FOMO fiasco. Date, December 2020. Loss, down $25,000. Lesson, if everyone's talking about it, you're already too late. Bitcoin at 29K, it's going to 100K, everyone said so. Twitter, YouTube, taxi drivers. Bought with size. It topped at 30K, crashed to 20K, panic sold the bottom. When your grandma asks about Bitcoin, the top is in. Exhibit D, the leverage lunacy. Date, March 2021. Loss, down $50,000. Lesson, 50-to-1 leverage is financial Russian roulette with 5 bullets. GameStop mania, this time is different. 50.1 leverage. What could go wrong? Everything. 1-2% move against me equals account gone. It moved 3%. The math was simple. My greed was simpler. Total tuition, $150,000. Value of education, priceless. Because I learned something, failures aren't failures if you learn. They're data. My failure framework. Document everything. Screenshots, emotions, thought process. Find the pattern. What repeatedly kills me. Create a rule. Never do X again. Make it automatic. Systems over discipline. Now my rules protect me from myself. 1. Stop loss on every trade, save me 200K plus. 2. Never average down, save me 100K plus. 3. When everyone's talking, I'm not trading, save me 150K plus. 4. Max. 10.1 leverage, saved my entire career. Each rule written in blood. Each rule worth its weight in gold. What's your most expensive mistake? Did you learn from it? Or did you just feel bad? Pain without progress is masochism. Pain with progress is education. Which are you choosing? Learning from failures is crucial. But there's one trait that separates pros from everyone else. Chapter 17. The Professional's Edge. Amateurs focus on being right. Professionals focus on being rich. Here's the difference. The pro protocol. It's not what they do. It's what they don't do. Amateur Alex. Trades every day. Can't miss opportunities. 15 positions open. Diversification. Checks phone every 5 minutes. Changes strategy monthly. Celebrates every win on Instagram. Professional Patricia. Trades 3 to 4 times per week. 1 to 2 positions max. Checks twice daily. Same strategy for 5 years. Nobody knows she trades. End of year results. Alex, down 37% and an ulcer. Patricia, up 67% and sleeps 8 hours. The difference isn't skill, it's behavior. But here's what separates professionals at a deeper level. Professionals track different metrics. Amateurs track win rate, P&L, account balance. Professionals track R multiple, expectancy, maximum drawdown. Amateurs ask, how much did I make? Professionals ask, how well did I execute? Amateurs focus, profits. Professionals focus, process. Here's a professional's actual trading log. Trade 1, followed rules perfectly, lost 1R, grade A+. Trade 2, broke position, size rule, 1, 2R, grade F. Trade 3, perfect execution, 1, 3R, grade A+. Notice, the losing trade got an A+, the winner got an F. Process over profits, always. The professional's commandments: preserve capital over make money, process over outcomes, boring over exciting, consistency over home runs, systems over emotions. Amateurs ask, how much can I make? Pros ask, How much can I lose? Amateurs focus on entries. Pros focus on exits. Amateurs want action. Pros want edge. But here's the professional secret that changed my career. The 2% club, risk max 2% per trade. Take only A-plus setups. Review every trade. Sounds simple? Is simple. That's why it works. Complexity is where amateurs hide their lack of discipline. Look at your last 20 trades. How many were planned? How many were impulsive? If more than 20% were impulsive, you're trading like an amateur. No judgment, just data. But data that could save your account. Are you ready to be boring and rich, or exciting and broke? Acting like a pro requires the right tools. Here's exactly what you need, and it's less than you think. Chapter 18. The Technology Stack. Traders spend $5,000 on courses but won't spend $15 on proper charting. That's like buying a Ferrari but refusing to pay for gas. The minimalist arsenal. You need 3 things. Everything else is procrastination. 2018. My setup looked like NASA mission control. 6 monitors, 15 programs, 10K invested. Results, information overload, confused, lost money. 2025, my setup fits in a backpack, 1 laptop, 3 programs, $50 per month. Results, clarity, focused, 7 figures. What changed? I learned the truth. Tools don't make the trader, decisions do. The only stack you need. TradingView Pro at $15 per month. Charts, analysis, backtesting, better than 3 KT platforms. Broker with API varies. Execution only, not for analysis. Journal using Google Sheets free. Track everything. Your real education. Total. Less than Netflix plus Spotify. But here's the tool nobody talks about. Your trading journal. Not just P&L. Deep analysis. Entry reason specific. Emotion before, during, after. Rules followed, broken market conditions. Lessons learned. My journal template. Date, pair, direction, entry, stop, target, result, grade, lesson. The grade column changed everything. Forces honest evaluation. A please equals perfect execution. B equals minor mistakes. C equals major mistakes. F equals broke rules. Track for 100 trades. Patterns emerge. Weaknesses exposed. Edge refined. That's it. Anything else is mental masturbation disguised as preparation. How much have you spent on trading tools? How much have you made from them? Are you buying tools to trade better or to avoid actually trading? Sometimes the best setup is the simplest one. Sometimes less really is more. Tools are worthless without community. And I learned this the hard way. Chapter 19. The Community Code. Trading alone nearly killed me, literally. Here's what saved my life. The isolation trap. Markets are psychological warfare. Don't fight alone. November 2019, 3 a.m., 7th straight losing week. Account, down 68% from peak. Relationships, destroyed. Health, what health? Hope, gone. I wrote in my journal, maybe everyone's right. Maybe I should quit. Maybe I should just... Then my phone buzzed. Message from a trading buddy. Rough week. You good? 2 words. Saved my life. We talked till sunrise. Shared losses. Shared pain. Shared hope. He'd been there, survived it. Showed me how. That conversation changed everything. But here's what really happens in good trading communities. It's not about signals. It's about survival. Real traders share massive losses and how they recovered. Broken rules and the consequences. Emotional breakdowns and coping strategies. Actual statements, good and bad. No ego, no facades, just truth. My trading group has 3 rules. 1. Share your worst trade weekly. 2. No hindsight analysis allowed. 3. Help someone newer than you. The magic happens in vulnerability. When a 6-figure trader admits they tilted and lost 20K, suddenly your $500 loss feels manageable. Trading isn't a solo sport. It's a team sport disguised as an individual one. You need accountability partners to keep you honest, loss support to keep you sane, strategy discussions to keep you sharp, success celebrations to keep you motivated, reality checks to keep you grounded. My first profitable year came after joining a serious trading group. Coincidence? No. But here's how to find the right community. Avoid groups that promise signals, only show wins, charge monthly fees, feel like cults. Find groups that share losses openly, focus on process, have experienced traders, feel like family. The best trading communities feel like AA meetings. Everyone's fighting demons. Everyone's supporting each other. Who knows about your trading? Really knows? Losses and all? If the answer is nobody, you're one bad week from disaster. Ego says trade alone. Wisdom says find your tribe. Which voice are you listening to? You've got the knowledge. You've got the tools. You've got the community. Now comes the moment of truth. Chapter 20. The 2025 Action Plan. In the next 3 minutes, you'll make a decision that determines whether you're still broke in 2026 or building wealth. No pressure. The timeline split. Every legend started with one decision, to begin. 2 universes, both possible, both starting, now. Universe A, the watcher. 1 year from today. Same job, same income, same dreams. Scrolling Instagram, watching others win. I should have started when I watched that video. Universe B, the trader, 1 year from today. 6 a.m., coffee in hand, checking positions, up $2,147 overnight. Those first 6 months of losses, worth every penny. Both futures are real. Both are possible. The only difference, what happens in the next 180 seconds. But wait, before you act, understand this. The real heist isn't stealing money from markets. It's stealing back your time. Every profitable trader reaches the same realization. Money was never the goal. Freedom was. Freedom to wake without alarms, freedom to travel without permission, freedom to say no without consequence, freedom to help without limitation. The account balance is just a number. The life that number enables, that's everything. I know traders with $10 million who are miserable, glued to screens, addicted to the game. I know traders with $1 million who are free. They trade 2 hours a day, spend the rest living. As you begin this journey, decide now. What does success look like? Is it a number or is it a life? Trade for the life, not the number. The number will follow. This isn't just about trading. It's about becoming who you were meant to be, using trading as the vehicle. The heist isn't about taking. It's about taking back your time, your freedom, your life. Now, are you ready to begin? Success isn't about IQ or capital or luck. Success is about one thing, starting. Chris Sacca started with 4 CEO borrowed on credit cards, now worth $1.2 billion. The hardest trade I ever made wasn't my biggest winner. It was opening my first paper trading account. Everything else was just repetition. 10 years from now, what story do you want to tell? I watched the video, it was good, then I did nothing. Or, I watched the video, opened a paper account that night, lost for 6 months straight, kept going. Now I trade for a living. Your story, your choice, right now. The final protocol, 3 actions. 30 seconds each, screenshot this roadmap. Week 1 to 4, paper trade religiously. Document every trade. Month 2 to 3, test with micro capital, feel real emotions. Month 4 to 6, apply to prop firms, use their capital. Month 7 to 12, scale and compound. Build your fortune. Open paper trading account. Link in description. $0 required. No excuses left. To prove to yourself that this isn't just another video you'll forget, go to the comments right now and write Day 1. This isn't for me, it's for you. It's your public declaration that today, you stop being a watcher and start being a builder. I'll be reading every single one, and your journey of accountability starts the moment you hit post. I'll personally track your progress. Free resources in response. Accountability starts now. 90 days later, send me your results. Real talk. 80% won't do anything. 19% will start and quit. 1% will transform their lives. The 1% isn't special. They just have one trait. They take the first step while others debate. Remember, every professional trader started exactly where you are. Scared, confused, broke. The only difference? They started anyway. Right now, someone just opened their paper trading account. Right now, someone just committed to changing their life. Right now, someone just joined the 1%. Was it you, or are you still watching? Welcome to the 1%. The heist begins now. See you on the other side, where freedom lives.